This is the tale of a bank that was founded after a poker game. A game of poker that resulted in this bank betting the house on Silicon Valley tech firms and utilizing their funds to go all in against the Federal Reserve. What kind of decisions did the founders of SVB make that ultimately led to the largest bank failure since the financial crisis? Before we begin, make sure to like this video and subscribe to the channel. Early in the 1980s, a group of pals gathered to play poker in Pajaro Dunes, California, at a house close to the beach. It was a typical poker game. Some win and some lose, but all of them decide to participate in the creation of a new bank to provide service to companies in the area, which is quickly becoming known as Silicon Valley. They chose the same name for the new lender without yet realizing that it will be the best choice for their branding. The next day, their wives and kids would arrive at their beachfront properties on Monterey Bay. But on that Friday night, the two men invited their closest friends over, prepared a substantial dinner, and discussed their plans to launch a bank geared toward the IT industry. They went to a group of notables for assistance, including a renowned football quarterback, an unconventional congressman, and the founding attorney of one of the Valley's most recognizable law companies. Ronald Reagan was the president at the time, and Congress was deregulating the financial sector. Additionally, the tech-focused concept for the bank was the brainchild of Medeiros, a Harvard MBA graduate who now teaches construction management on a part-time basis at Stanford. He approached Wells Fargo official Biggerstaff, a friend of his, and the two men worked together to appoint Roger Smith, another Wells Fargo executive, as president and CEO. And so, the Silicon Valley Bank was born. The three compiled a roster of 100 founders, including former Stanford star quarterback Jim Plunkett, who won the Super Bowl 18 with the Los Angeles Raiders 6 months after the bank opened, and their poker partner, Star Colby from Lockheed. The who's list of founders served as the calling card for the new bankers. It seemed that SVB was going pretty well. The business was stable, and they even offered generous loans to startup companies in the area, long before their businesses ever turned a profit or even obtained significant capital. Silicon Valley Bank treated startup owners like royalty. SVB swiftly established itself as the go-to bank for anyone interacting with the well-known startup scene in the San Francisco Bay Area by providing loans, advice, copious amounts of good wine, and expense-paid ski holidays to businesses with little revenue for larger banks to support. On top of that, they even took extra safety measures by becoming a member of the FDIC. What does FDIC mean? In the event of bank failures, deposits held in American banks and thrifts are protected by the Federal Deposit Insurance Corporation, or FDIC, as long as the institution is a member company, which SVB is fortunately. Deposits up to $250,000 per depositor are insured by the FDIC. Although this was the case, Silicon Valley Bank hit a bump in the road. The bank could not insure 90% of depositor accounts due to them exceeding $250,000. As the feeling of risk increased, they hurried to transfer funds. But the distinctive ways in which Silicon Valley Bank functioned, as well as the most recent sell-off in government bonds caused by the Fed's aggressive rate hikes, which damaged the bank's assets, may have also presented dangers. Now, it seems that all hell is broken loose. What happens to the money of SVB's clients? In the event that a bank should ever fail, depositors will get a prompt refund from the FDIC. Thankfully for SVB's depositors, the protected deposit money for the bank became accessible on March 13th. Nevertheless, that doesn't imply the remaining deposits will be fully lost, but it relies on the state of the bank's balance sheet. In the past, amounts greater than $250,000 have typically gotten the majority of their money back, but it takes longer while the bank is shut down. Additionally, in situations when many named individuals are identified as account owners and across various types at the same bank, the $250,000 insurance maximum can be effectively expanded, resulting in higher amounts of aggregate insurance. Also, the $250,000 deposit insurance limit may apply to each individual bank account if you have accounts at many banks. Last but not least, not all account kinds, investments, and financial institutions are covered. FDIC insurance is meant to prevent bank runs, but it seems obvious that Silicon Valley Bank was not a victim of one. Now it's time to ask the question, how exactly did SVB find themselves in this situation? The bank that provided loans to startups and venture capital firms exposed its cards, which led to the catastrophe. Ratings company Moody had secretly informed bank officers that they were thinking about downgrading in early March. The reason was that SVB had placed a sizable portion of the deposits made by its clients in government bonds, which, while theoretically quite safe, had lost value due to the considerable increases in interest rates that the Federal Reserve had permitted last year to fight inflation. The hiring of Goldman Sachs by Silicon Valley Bank and the sale of a portfolio of bonds to it resulted in the realization of unrealized losses totaling 1.8 billion euros. To strengthen its liquidity, it also chose to start a $2.25 billion capital increase. It thought it had a winning hand. The way the operation was carried out was terrible. The SVB presentation to analysts on March 8 demonstrates how disconnected bank managers were from the reality that was about to strike them. Rather than aiming to borrow money to repay depositors at that time, it was doing so to protect its credit rating and reinvest the proceeds in securities with better interest rates. SVB admitted in the operations prospectus that deposits were lower than anticipated as a result of clients, primarily tech companies, using more cash. The bank made the decision to liquidate its debt portfolio first, which required realizing its unrealized losses and postpone issuing new shares until the next day. This was a grave mistake. To put it another way, the Fed kept interest rates at 0% for 2 years in a row, which forced SVB to take on enormous amounts of deposits, increasing the bank's market cap from $11 billion to $44 billion during that time. Banks make money from interest on loans, but with interest rates at 0%, SVB had to invest heavily in government securities to generate income, which is great until interest rates rise. When inflation is rising, banks will raise interest rates to encourage individuals to spend less and save more. Interest rates and inflation typically move in the same direction. The demand for goods and services should decline as a result, helping to keep inflation under control. Before we proceed with the rest of the video, don't forget to give this video a thumbs up and subscribe to the channel for more stories like this. Now, let's get back to it. It appears that SVB's worst nightmare has now occurred. In order to reduce inflation, the Fed increased interest rates and this week informed Congress that they expect to let them rise as high as 5.75%, which is significantly higher than zero. The decline in technology stock prices over the previous year and the Federal Reserve's aggressive intention to raise interest rates to fight inflation both had a significant negative impact on Silicon Valley Bank, SVB. Although these investments were generally safe, their value decreased because they carried lower interest rates than a comparable bond would have if it had been issued in the current climate of higher interest rates. Nonetheless, the majority of SVB's clients were startups and other tech-focused businesses who began to require more funding during the previous year. Due to a lack of available venture capital investment, firms were forced to use their already placed cash, which were frequently deposited with SVB, which was located in the epicenter of the tech startup universe. Customers of SVB then started taking their deposits out. That wasn't a big deal at first, but as withdrawal requests increased, the bank had to start selling its own assets to cover them. Since the majority of SVB's clients were rich corporations, they were probably more concerned about a bank failure because their savings exceeded the $250,000 cap set by the US government for deposit insurance. This necessitated the loss-making sale of ordinarily secured bonds, and as a result, SVB virtually went bankrupt. SVB had to look for outside investors in an effort to obtain more money, but it was unsuccessful. A bank run, the oldest problem in banking and one of the few things that can definitely sink a bank, brought down the sleek, tech-focused institution. In order to safeguard the assets and depositors that were still held by the bank regulators had no choice but to seize SVB's assets, and that's how the bank met its inevitable end. Withdrawals from deposits were made quickly and in record amounts. After a few hours, customers wanted $42 billion in refunds. The prophecy became self-fulfilling due to the concentration of deposits in a single industry, the great majority of deposits being uninsured, and herd mentality. If every customer requests the money back at once, no bank has the liquidity to do so. That is why bank runs are so risky. And these days, the risk is even higher because we live in the digital era. Even customer lines outside the bank are unnecessary in the digital age. All you need are transfer requests made on laptops and cell phones. The bank run that caused Silicon Valley Bank, SVB, to fail made it the second largest bank failure in American history and the biggest since the 2008 financial crisis. And that's the end of the video. If you enjoyed watching, make sure you give this video a like and subscribe to the channel for more content. Thanks for watching, and I'll see you in the next one.